Welcome back. So far, we've seen how you can make money or lose money trading credit default swaps. But whether you're making money or losing money, the question is, how do you book your profits or losses? In other words, how do you unwind a CDS trade? And that's what we're going to look at now in this video. Traditionally, there were three ways in which you could unwind a CDS trade. The first was terminating the CDS contract with the original counterparty. The second was something called as novation, which means assigning the CDS to a third party. And the third option was offsetting, meaning entering into an equal and opposite trade. But after 2008, with all the reforms and changes that the CDS market has undergone, a large number of trades today are cleared through clearinghouses, which in the world of over-the-counter derivatives are known as central counterparties. So that adds a fourth option in the mix. Now, before we look at each of these options in detail, it's important to give you a background about the structure of the CDS market. Remember, we said in the first part of our series that CDS is a market for institutional investors, not retail investors. By institutional investors, we mean broker-dealers on the one hand, which are essentially the large investment banks, and these guys form the sell side of the market. On the other hand, we have asset managers, hedge funds, insurance companies, commercial banks, etc., which together form the buy side of the market. Now, as things stand today, inter-dealer trades account for 30% of the gross notional outstanding in the CDS market. And this is according to the latest data from the Bank for International Settlements, commonly known as BIS. Central counterparties account for a little over half of the market, while banks, insurance companies, hedge funds, commercial banks, etc. account for the rest. Okay, with that understanding of the market structure, let us now look at the mechanics of unwinding a CDS trade. Here is an example of two counterparties in a CDS trade. Let's call one of them A and the other one B. Now, each of these two counterparties can be a buyer or a seller, it doesn't matter. The first method of unwinding, as we mentioned, is to terminate the contract with the existing counterparty. Suppose counterparty A in our example wants to exit the trade. So she goes to her original counterparty B and asks her to terminate the contract. If B agrees, then both counterparties simply tear apart their existing CDS contract. There will be no more coupon payments after this, neither will there be any payout if there is a credit event. The one who's making a profit on this trade takes home a profit, while the other person takes home her loss. Simple, isn't it? Again, it's important to understand that the offer to terminate can come from the buyer as well as from the seller. It does not matter. All that matters is one of the counterparties offers to terminate the contract and the other one agrees. Okay, that's great. But what happens if the other counterparty does not agree to terminate? Let's say B declines A's offer. B is making money on this trade and she wants to hold on to a position in the hope of making more money in future. So she says no to A's offer to terminate the contract. What is A going to do now? Well, one thing that A can do in this case is assign the contract to a third party. In CDS language, this is known as novation. So let's say A goes looking out in the market and finds C, who's probably a dealer. C agrees to take over the obligation from A at the current market price. Now, does that mean A can assign the CDS to C? Well, not so soon, because this is where B, the original counterparty of A, comes into picture. But why? What does B have to do with it? Isn't this a deal between A and C? Well, not really, because if A assigns the CDS to C and leaves the scene, then it becomes a contractual obligation between B and C, isn't it? So let's assume B has a long position in this trade. That means after the assignment, C is going to have a short position. Therefore, in future, if there is a credit event involving the reference entity of the CDS, then C will have to pay up the notional amount, isn't it? That means B needs to be sure that C can honor her obligations, needs to be sure that C indeed has the capacity to pay the notional amount if a credit event does indeed take place. Otherwise, B is not going to allow to assign the CDS. This fact is known as counterparty credit risk. It's an extremely important concept in financial markets, particularly in markets for over-the-counter derivatives, such as CDS. In fact, counterparty credit risk was the source of the 2008 financial crisis, including all of its episodes, be it AIG, be it Lehman, or Bear Stearns. So in our example, B needs to be sufficiently sure that C is not going to default on its payment if there is a credit event involving the CDS they are trading. But how can B be sure that C is not going to default? Well, if C is a big name in the market, like a Goldman Sachs or JP Morgan or a Credit Suisse, then B can be reasonably sure that there won't be a default. A counterparty as big as that is surely not going to default, at least not under normal market conditions. But if C is not a market biggie, then what happens? In that case, C on its part will need to assure B that it is not going to default. How can C make that assurance? The way to do that is to post collateral for that trade. So C might be owning some securities, could be bonds or stocks or something else, which it deposits as collateral into the trade. It basically means that if C is unable to pay the notional amount in case of a credit event, then B gets to keep the collateral, those securities that C has deposited into the trade. Okay, so now with that collateral in place, B is reasonably satisfied about C's credit risk. Therefore, our friend A can now assign the CDS to C, book her losses, and go home. And after that assignment, it's now a CDS contract between B and C. So that's option 2 for you, assigning the CDS to a third party. Now let's look at the third option, offsetting. As the name suggests, it means entering into an opposite trade with the same notional, same maturity, and involving the same reference entity. In our example, let's say A had sold a 5-year CDS 2 years back. Now, to offset that trade, she can buy a CDS on the same reference entity with 3 years to maturity. She had sold a CDS of 5-year maturity 2 years back. Now to offset that trade, she's going to buy a CDS referencing same entity with 3 years left to maturity at the current market price. And after she's done that, A now has a short CDS position as well as a long CDS position on the same reference entity. Therefore, she's default neutral. It doesn't matter to her anymore if the reference entity defaults. Plus, since the coupons are the same, they essentially cancel each other out. So on the net, she neither receives anything nor pays anything. Her only payoff from this trade is the difference between the upfront money she received when she sold the CDS originally and the upfront payment she made to buy an offsetting CDS. Okay, so that was option 3 for you, entering into an offsetting trade to unwind a CDS position. Now, the 3 options we've just discussed have been in place right from the time the CDS market started. But after 2008, with the introduction of standardized contracts and central counterparties, the mechanics of unwinding a CDS trade have changed considerably. In fact, it has become a lot easier and simpler to unwind a CDS now than what it used to be earlier, because more than half the CDS market, in terms of gross notional outstanding, is cleared through central counterparties. So what a central counterparty does is, it sits between the 2 actual counterparties in a CDS trade. So today, if you want to trade a CDS or if you want to unwind a CDS trade, you have the choice to go via a central counterparty, provided of course you are trading a standard CDS contract. So if you want to unwind your position, you simply assign the CDS to a central counterparty and you're done. The central counterparty will then look for a third party to reassign that CDS. And that third party could be a dealer, or it could be somebody else like a hedge fund or an insurance company. Remember, your payoff doesn't change whether you're going through a central counterparty or directly to a third party. Your net payoff at the end of the day still depends on the market prices of the CDS at the time of entering the trade and at the time of exiting it. So that's the 4th way in which you can unwind a CDS trade today, through a central counterparty. And this option, of course, didn't exist earlier, but it does now, and it has made lives a great deal simpler for CDS traders. So hopefully that gives you an idea of how you can unwind your CDS trade and book your profits or losses.